Three savers are watching this video right now. The first has $20,000 sitting in a regular savings account, collecting $76 a year and calling it responsible. The second moved to a high-yield account, is earning 10 times more, and feels like they cracked the code. The third found something neither of them knows exists. A Bitcoin-backed preferred equity instrument, paying them nearly double what the second saver earns every single month. The question isn't which one is right. The question is which one are you? Before we dive in, do me a quick favor. Hit the like button and subscribe to the channel. It takes 2 seconds, and it tells YouTube to show this kind of content to more people who actually need it. Alright, back to the question. By the end of this video, you'll know exactly which one of these three savers you should be. You'll also see why Bitcoin quietly rewired the entire idea of what a savings account can do. Quick question before we go further. Have you ever done a bank transfer, sent money from one account to another? Ever wonder why an ACH transfer takes 3 full business days to clear? Why moving your own money in the year 2026 takes longer than ordering something shipped from across the country? Yeah, this is why. While your bank is busy processing that transfer, they're not just moving numbers, they're using your money, lending it out, earning interest on it, squeezing every last hour of value out of the float before they finally hand it over. That 3-day delay isn't a technological limitation, it's a business model. By the end of this video, you'll understand exactly how it works, and why the smartest savers stopped participating in it years ago. Let's start with Maya. Maya did everything she was told to do. She saved 6 months of expenses. She kept it in a savings account at a big national bank. She checked her balance every month and saw a small interest deposit. It wasn't much. A few dollars here, a few dollars there. But it felt responsible. It felt safe. Her account is paying 0.38% APY, the national average right now according to FDIC data. On $20,000, that's $76 a year, about $6.33 a month. Not even enough to buy lunch. Maya probably never thought about what her bank was doing with that $20,000 while it sat in her account. She probably assumed it was just sitting there in a vault somewhere, waiting for her. It wasn't. The moment Maya deposited that money, the bank put it to work. Not for her, for them. Step 1. The bank lent it out. That's the core business model of every bank in America. They take your deposit, pay you a fraction of a percent, and lend that money to someone else at a much higher rate. The difference between what they pay you and what they earn is called the net interest margin. Right now, the average net interest margin for US banks is 3.39%, the highest it's been since 2019. Let's put that in real numbers. Maya's bank paid her 0.38%. They earned 3.39% on the money they lent out using her deposit. Maya got $76. The bank got roughly $678 from the same $20,000. That's just the average. Look at where the margins really widen. Credit cards run at an average APR of around 21%. Maya's bank takes her deposit, pays her 0.38%, and turns around and lends that money to credit card holders at 21%. That's a spread of over 20 percentage points. Auto loans around 7.5%, mortgages around 6.8%, personal loans around 12%. Every one of these is funded in part by deposits like Maya's. Every one of them earns the bank multiples of what Maya receives. Then there's the treasury trade, the one that should make you pause. Maya's bank takes a portion of her deposit and buys short-term US Treasury bills, yielding around 3.6%. The bank earns 3.6%. Maya gets 0.38%. That's a spread of 3.22% on an asset Maya could have bought herself. The bank is literally acting as a middleman between Maya and the US government, charging her over 3% for the privilege. Then there are the fees. American banks collected an estimated $12.1 billion in overdraft, NSF, ATM, and maintenance fees in a single year. JP Morgan Chase alone collected over $1 billion in overdraft fees in 2024. Add it all up, Maya's bank didn't hold her money. They rented it. They paid her $76 a year for the right to use her $20,000 however they wanted. She thought she was earning interest. Now let's talk about Jordan, because Jordan is the person watching this video thinking, I already knew that. That's why I moved my money to a high-yield savings account. Jordan's not wrong. He's ahead of Maya, Way ahead. His account pays 4.5% instead of 0.38%. On $20,000, he's earning about $900 a year, compared to Maya's $76, 10 times more than the average saver. So what's the problem? First, that 4.5% might not be what Jordan is actually earning. Many high-yield accounts advertise up to a certain rate. That up to is doing a lot of heavy lifting. Some accounts use tiered structures, where the top rate only applies to the first $500 or $1,000. After that, the rate drops. Others offer a promotional rate for 90 days, then quietly reduce it. Jordan saw 4.5% in the headline. His effective rate might be lower. Second, the tax treatment. Interest earned in a savings account, whether traditional or high yield, is taxed as ordinary income. Federal, state, and local. If Jordan is in the 22% federal bracket and lives in a state with a 5% income tax, he's losing over a quarter of his interest. His $900 becomes roughly $657 after tax. Third, and this is the big one, what is Jordan's high-yield savings account actually doing with his money? Where does the bank get the returns to pay him 4.5%? Exactly what we just described with Maya's bank, lending it out, buying treasuries, running the same profit machine. The only difference is that a high-yield account shares a bigger slice of the profit with the depositor. It's still a slice. The bank is still the middleman, and the middleman is still taking a cut. Here's the question Jordan never asked. If the bank is using my money to buy treasury bills and earn 3.6%, why don't I just buy the treasury bills myself? Some people stop here. They figure it out. They open a brokerage account, buy a US Treasury ETF like SGOV, and cut the bank out entirely. SGOV's 30-day yield is around 3.55%, and its trailing 12-month yield is around 3.95%. On $20,000, that's $710 to $790 a year. Slightly less than Jordan's high-yield account on paper. But Treasury interest is exempt from state and local income tax, which closes most of the gap, especially in a high-tax state. That's where most informed savers stop. They've cut out the bank. They're lending directly to the government. Mission accomplished. But the real ceiling isn't Treasury bills. There's an entirely different category of yield-bearing instrument that almost no traditional advisor will tell you about. It's where the third saver in this story lives. Meet Elena. Elena treats her money like a small business. She's not chasing returns, she's building cash flow. Every part of her savings is structured around one question. Is this dollar earning or is it sitting? A regular savings account earned her almost nothing. A high-yield savings account earned her a little. A US Treasury ETF, like SGOV, earned her more than either of those and cut the bank out of the equation. Each step was progress. None of them gave her what she actually wanted: monthly cash flow that felt meaningful on the capital she had sitting idle. Then she discovered Bitcoin Treasury Preferred Equity. Here's what that means. A growing list of publicly traded companies, Strategy, now operating as Strategy, Strive, Metaplanet, others, they have built their corporate strategy around accumulating Bitcoin on their balance sheet. To fund that accumulation, they've issued preferred equity instruments, securities that pay holders a fixed dividend on a regular schedule, backed by the company's operations and the underlying Bitcoin treasury. MicroStrategy's offering is called STRC, and it's the one Elena uses. STRC is structured with a par value of $100. The price does swing a bit day to day on the open market, but nothing like the volatility of spot Bitcoin. It's designed to trade in a much tighter band around par, more like a fixed income product than an equity. The dividend yield runs between 8% and 10% annually, paid out monthly, in dollars, directly to your brokerage account. Run the numbers against the savers we've already met. Maya earned $76. Jordan earned $900. The SGOV holder earned $790. Elena earns between $1,600 and $2,000 on the same $20,000. The yield is the headline number. What actually matters to Elena is the cash flow. Every month, distributions hit her brokerage account in dollars. STRC does what a savings account never could. It generates meaningful, regular income on capital that would otherwise sit idle. Elena didn't find a better savings account. She built a yield machine. Now, let's be honest about what this is. No responsible video on this topic should skip the risk side. Bitcoin Treasury Preferred Equity is not a treasury bill. A treasury bill is backed by the US federal government, which has the ability to print money to pay its debts. The credit risk is essentially zero. Preferred equity in a Bitcoin treasury company is backed by a corporation that holds Bitcoin. There are real risks here. If Bitcoin's price crashes hard and stays down for years, the issuing company's balance sheet weakens. If the company struggles, dividends can be suspended. The preferred shares trade on public markets, which means their price can move day to day. Even though they're designed to behave more like fixed income products than equity, the volatility is real. These instruments are also not FDIC insured. They're not government guaranteed. They're financial securities with credit risk, market risk, and the specific risk of being tied to one company's Bitcoin strategy. So this isn't a park your emergency fund here play. This is a yield strategy for capital you can afford to deploy with some risk on a thesis you believe in. If you believe in Bitcoin's long-term trajectory and you believe the companies issuing these instruments are operating responsibly, the risk-reward looks different than it does to someone who has no view on Bitcoin at all. That's the honest framing. Higher yield, higher risk. A different mental category than a treasury bill or a savings account. Elena understands this. STRC isn't where she parks money she might need next week. It holds a specific layer of her capital, the portion she's willing to deploy with some credit risk in exchange for materially higher yield, paid in dollars, on a thesis she already believes in. Here's how Elena actually structures her cash, layer by layer. Layer 1, checking account. Keep it. You still need it for daily spending. Bills, rent, groceries, whatever comes in and out regularly. This is working capital. Don't move it. The whole point of a checking account is friction-free access. Layer 2, emergency fund. 3 to 6 months of expenses. This belongs in something like SJOV or a treasury money market fund. Liquid, government-backed, state tax exempt, earning around 3.5 to 4% without taking corporate credit risk. This is the layer where safety matters more than yield. Layer 3, idle savings. Money you don't need in the next year, but you want to keep relatively liquid. This is the conversation layer. You can leave it in SGOV. You can also allocate a portion to STRC for the higher yield, knowing the risk profile is different. Elena allocates a meaningful portion of her idle savings here. She accepts the credit risk in exchange for the yield and uses the monthly distributions however she wants, reinvesting, spending, or building further positions. Each layer serves a different purpose. STRC isn't replacing your emergency fund. It's filling a middle layer most people don't even know exists. Yield-bearing exposure to a Bitcoin-aligned company, paying monthly cash flow that traditional finance never thought to offer. Maya doesn't have this layer. Jordan doesn't have this layer. Elena does. Once you see it, the entire structure of where your money sits starts to make more sense. Let's be honest about what actually separated these three. Maya didn't know the question to ask. She trusted her bank to do the right thing with her money. She never thought to look behind the curtain. She just followed the rules she was handed. Jordan asked one good question. He asked why he was earning so little, and he found a better account. But he stopped there. He didn't ask the next question. He didn't follow the thread far enough to realize his bank was still doing the same thing with his money, just sharing a slightly bigger slice of the profit. Elena asked the question all the way through. What is my bank actually doing with my money? Can I do that myself? Once she got to the treasury layer, she asked one more question. Is there anything beyond this? That last question is what most people never ask. They think treasury bills are the ceiling. They're not. They're the floor for someone who understands the broader landscape. The gap between these three wasn't intelligence. Maya and Jordan are smart. The gap was attention. Elena gave her money the same attention she gave her career. She studied, she read, she asked the next question. She found a layer that paid her significantly more for the same idle dollars. That layer is available to anyone with a brokerage account and the willingness to learn the risk profile. There's no secret club. There's no minimum balance you need. There's just information, sitting in plain sight, that most savers haven't bothered to look at yet. Maya was responsible. She saved her money. She kept it in a bank. She checked her balance. She did everything right by the rules she was taught. Jordan was informed. He moved to a high-yield savings account. He earned 10 times what Maya earned. He thought he'd cracked the code. Elena was awake. She asked the question all the way through. She found a layer paying her more than Maya and Jordan combined, every single month, built on top of Bitcoin without requiring her to touch the asset directly. 3 savers, same starting capital, 3 completely different outcomes. The question isn't which one is right. It's which one are you? The better question, which one are you ready to become? If this video showed you something you didn't know was happening with your money, hit the like and subscribe button.